Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for the segment, we have Steve Sosnick, chief strategist at Interactive Brokers, to discuss why stock traders remain relatively sanguine as their fixed income counterparts run to the exits. Steve, it's great to see you as always. And before we get into that, what do you think about the way February went? It seemed like a lot was packed into the shortest month of the year.
Yeah, I mean, when you think about the round trip that we had, just even in the first week or so, right, between the FOMC meeting, the love of the word disinflation from Powell, and then the stupendous rallies we had the next day, which by the way is what I consider the day that brought zero DTE options to the fore, because NDX was up about 3.5%. The options and Qs were going incredibly. We're going fast and furious, and they were doing similar in spiders and other things. And then we had that huge reversal the next day that began with the payrolls report. And during the month, we had three successes, at least three, but PPI, CPI, and PCE deflator, all coming in hotter than expected. Yet after all this, indices were really not down very much. NDX was down about 1%. In the meantime, though, bonds were up 60 basis, depending on your part of the curve, 45 to 60 basis points in February, as were expectations for peak Fed funds rates. And so the fact that stocks managed to just sort of skate through the month with a relatively unchanged scenario, despite all that backdrop, is actually kind of remarkable to me. So it says we're pretty resilient still, and the risk-on mentality that we started to see in January is at least there in the background, if not necessarily in the forefront as it was.
Yeah, and it's interesting because equity traders remain relatively unfazed as their fixed income counterparts are running to the exits. You have a few theories on this. Explain to us what's going on here.
Yeah, I mean, one of the most basic theories are one of them is, quite frankly, they can persist at differential. They can miss each other for long periods of time. I started in 1987, just aged myself. But bottom line is, when I was a Salomon Brothers trainee and you were running around the various floors talking to people, and the bond traders were miserable because they were in this grinding bear market. Stock traders were seeing a bull market that they'd never seen before. And then I actually can pinpoint it. There were some big asset allocation trades. It was tough to do in those days. And I remember Solomon handled them. I was not really a party to these things, but at that point I was too junior. But somebody, couple of state pension funds moved billions out of bonds into stocks, and that was the precipitating factor. And then, of course, later on, the bond traders were all happy and the stock traders were all miserable. But so you can persist along those lines for quite some time. Yeah, I'm not going to say it's irrational because they're looking at different things to a certain extent. Bond traders are laser focused on inflation, monetary policy. That's really all they have. If you're a government bond trader, if you're trading stocks, there are stories, and there's a million stories in stocks. And I will say the stocks that lead Nasdaq, the tech stocks, have varying stories, and many of them are quite good and quite exciting. And so you can get this divergence for some time. The mindsets can be very different.
Right. And Steve, I want to take a look at your first chart here, because we talk about the spread between vol-Q and VIXN all the time. What are you seeing there now?
I'm seeing, we know that they're both down recently. Over the past couple of days, there's really been this sea change in terms of, going, basically volatility measures, I'm not going to say collapsing, that's a bit strong, but they've come off after we rallied yesterday. Over the last 2 days, today they've been sinking further. But what we're seeing now is not a big, it's on the very low side of a spread between vol-Q and VIXN. And remember, what vol-Q is doing is it's measuring the at-money volatilities very specifically, whereas VIXN, it takes into account all non-zero bid options on NDX and on NDX, and so people aren't really rushing for at-money volatility, and people really aren't rushing for wings either. I think this goes back to the idea that investors are very sanguine, risk on. You could paint it with whatever verbiage you want, but that's really the mindset. Is I think people are not really particularly fearful right now and not really looking for insurance.
Yeah, and Steve, with your final chart here, we can see it from another technical perspective, how the Nasdaq 100 and of course the S&P 500, there's just a lot of support there.
Well, that's what we're seeing. I mean, we've got all these moving averages, depending on your index of choice, but you've got these, the 200-day, the 50-day, they're all sort of converging around current levels. And I think the rally we saw yesterday, which was, the precipitating factor was maybe Fed President Bostic's comments about, quarter point hikes. Although those were factored in, those were the base case before and after his comments. But we bounced off these levels. And quite frankly, the way I feel right now is it's going to take something for us to pierce through those levels. We're not just going to do it on an any day basis. On the other hand, what some of the measures like VolQ are telling us are that nobody's really expecting them to happen over the next 30 days. Those 30 days include Chairman Powell's semi-annual testimony next week, payrolls numbers next Friday, CPI, PPI the following week, and a Fed meeting the week after that. So there's a lot coming down the pipe in the next 30 days. There's always something coming around, but these are some big ones. And I think for the market to just sort of, say, okay, we held support and let's move on, that may be a bit premature.
Yeah. All right. Well, we'll see you next Friday for the payroll numbers. Great to see you as always, Steve. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.